The broadcast is now starting. All attendees are in listen-only mode.
Good evening. This is Thomas Beyer speaking. I'm the president of Precious Properties. I welcome you tonight, and I appreciate your time that you've taken out of your schedule. This is the second out of a series of 3 broadcasts to talk about apartment building investing and investment options. I have with me Christine Copper, who recently joined us, and she will be on the screens here shortly. You have in front of you a panel on the right-hand side. I encourage you during the presentation to type in questions on the bottom right corner if you have any questions, so we can answer those at the end of the broadcast. So what we're going to talk about tonight is how you can grow your wealth with hassle-free apartment building investments. And before we do that, of course, as the always important legal disclaimer that we cannot predict the future, and therefore any return will show you. Christine, the slide moved automatically. I'm not sure what happened. So we cannot predict the future, and therefore, Christine, maybe you have your slideshow on a timer. It moved automatically without me doing anything. Can you please reset this presentation? Sorry, guys. We are in 2 different locations, and sometimes this happens. So I talked about the legal disclaimer that we can't guarantee anything. Not every person who wants to invest can necessarily invest with us. There's a minimum time horizon to invest in. There's eligibility requirements set by the security commissions, and there's also a minimum investment required. However, we have to date about 600 investors, and this chart shows you essentially what type of investor we're looking for. You may have read or heard that Twitter today did the IPO. So that certainly is a market space one can invest in. And if you're lucky enough to perhaps work part of the IPO, you would have made 70% today, because the stock jumped from $25 to about well over $40 in a day. Well, we shall see what happens over the next few days. So this is not the type of investment we're offering. We're essentially looking for 2 types of investors. Both would be fairly conservative investors who look primarily for a return of their capital. Security of capital is critical. Obviously, if you invest money in any investment, there's always a chance you're losing some money. And I would argue that the risk of losing money with us is fairly low. Of course, the Security Commission will give you a form you have to sign which says this is a risky investment. In fact, all exempt market products will have to adhere to that form. So we have 2 options if you invest with us. One is the income option, and one is the what we call DRIP option, where you accumulate additional units, which is more designed maybe for younger investors, perhaps folks who have a longer view, who do not need income because they're usually working, and they don't want to have income where they actually have to pay taxes on. So if you're an investor looking for income, you're certainly welcome to invest with us and with some moderate growth. Or if you're not an income seeker but looking for growth because you want to own or co-own some assets and then see the appreciation through time. So obviously, as I mentioned, in Twitter, you have a choice, and the stock market offers plenty of choices to invest, either directly or through its more esoteric and more expensive cousin, the mutual fund. What this chart shows you for the last 13, 14 years is the stock market performance on TSX, and depending on when you entered the market and when you exited, you can see that it goes up and down like a yo-yo, because one of the benefits, of course, of investing in the stock market is liquidity. But that's not your benefit only, but it's also the benefit to other investors. So if Bernd Bernanke says something, or Barack Obama says something, or Stephen Harper does something, or some mayor in some undisclosed city smokes some crack, which may affect the stock market, all of a sudden stocks move up and down for sometimes really no good reasons. So what we offer is an investment vehicle outside the often manipulated and volatile stock market. So if you draw a line from, let's say, 2000 to about 2013, you see maybe a 2% growth in stocks, which is before mutual fund fee of perhaps 2%. If you're lucky enough to perhaps invest at around 7,000, and now it's today, what, 13,000, you might have done a 60-70% return over 12, 13 years. That's 5%, again, before mutual fund fees, so maybe you've done 3 or 4%. So if you invest in a mutual fund, I think you should not expect more than 2% on average. If you invest on an index, an ETF, maybe 4% is a decent assumption to use, perhaps, for stocks going forward, which barely covers inflation. And of course, GICs at 1 or 2% are often also safe investments, but not exactly income yielding. So what we do and how we create wealth for you, and us, of course, as well, is we also co-investors in this fund, is that we buy, improve, and then manage undervalued apartment buildings, specifically in Western Canada, specifically in Alberta and Saskatchewan, specifically in growing cities like Edmonton or Red Deer or Calgary. We focus on positive cash flow buildings. We look for appreciation, and we look for mortgage paydown. So all three. The cash flow is often tight to slightly negative in the beginning. We then reinvest in the asset as the rents go up and the value goes up. We then use that cash flow to further improve the buildings. We'll show you a few pictures. We may also refinance the building from time to time. But we also pay our mortgages down once we have locked in, let's say, a 5-year mortgage. So the fellow speaking is me. I'm the founder. I bought my first condo for $80,000 in 1997. After I bought 3 condos, I realized perhaps buying the whole building is more efficient. Instead of paying $80,000 a door, I paid about $37,000 a door for my first building in the year 2000 when I founded the company. I bought 3 buildings with my own money, and then I invited others, people in my circle of influence and friends and family, to invest with me for about 2-3 years, and then we started doing syndications on a larger scale with offering memorandums ever since 2005. We've transacted about $175 million in real estate since then. I have an MBA from Alberta in the U of A, where my 2 kids are attending now. I hail originally from Germany, and I went to the Technical University of Munich, where I did the computer science degree. I'm also working part-time, very part-time, as a politician and treasurer of our local municipality here, where I live at UBC now, in Vancouver. I work a lot with RAIN, blog a lot. I'm an honorary member of the RAIN group, and also now an advisory board member, and have won quite a few awards with them almost every year. Just published a book called 80 Lessons Learned on the Road from 80,000 to 80 million. A lot of stuff you learn as you syndicate money, as you buy buildings, and as you go through a recession, which we had from 2007 to about 2010. It wasn't all pretty, perhaps, but we haven't lost any investor money so far, which is really good news, despite all the carnage out there in terms of companies going bankrupt or just folding. And as I mentioned, I was previously in the software business, worked with IBM as IBM business partner for many, many years, and then decided to buy real estate in the late 90s, and have been doing it full-time for about 8-9 years now. Obviously, you can't do it all yourself. Once you manage, $100 million worth of assets with almost 1,000 tenants, and to raise money from 600 investors, again, you need partners. One such partner is Scotty, who has been with Presspro for about 6 years. He has raised about $35 million with us. Was active before that in both private and public companies for many, many years. lives in West Vancouver, and is also active in the marine search and rescue operations out in the waters. The other partner is Mike Hammerlindl, who hails from Calgary, who has a civil engineering degree, has finished his certified commercial investment member certification about 3 years ago, is basically my right-hand man as it comes to acquisitions and initial value amplifications, and also dispositions, because we do occasionally sell buildings. We tend to buy more than we sell, but we do sell buildings occasionally. He has also invested personally since 2001, when he was barely out of high school. So he has a long track record also of investing. We have, I founded a property management company in the year 2005, when we went to about 400 units under management, and have since, and that company was spearheaded by Rick at the time, who was the fellow at the bottom. He is now working part-time with us, managing primarily our buildings which are outside of Alberta, namely the one in Sudbury, Ontario, and the one in Dallas, and helps with special ops situations. He has now passed the reign to Keith, who is the co-owner of the associated property management firm called Fireside Property Group. This company manages about 600 units of press prop, essentially all the buildings except the one in Dallas and in Red Deer, and about another 1,000 units of other owners, mainly in Calgary and Edmonton. He has worked for over 20 years with other property management firms of very large size in Canada, such as Gateway, Translope, and Willstar. So these two gentlemen, plus my own experience, we have a lot of management experience of taking assets from its initial ugly state into a prestigious and cash flowing state. We also have an operations team. Christine is part of that, as she's in the top right. You'll hear her voice in a few minutes. We have two gals in Canmore, Michelle and Marianne, who run all the back office in terms of investor accounting and property account and LP accounting and investor mailings, and annual tax filings and security filings and withholding taxes for our foreign investors, and just make sure that all the paperwork is up to snuff. And then Denise on the bottom right, she works primarily with Scotty as his assistant in the inflowing money side, interfaces with Olympia Trust for the RRSP'S, and is a very busy girl right now because we have a lot of investor interest to invest in fairly secure, fairly stable, cash flowing, appreciating assets, which are not as volatile as the stock market. So that's the team, very small team, 8 people. It's 9 people, it's very tight. We have a very good track record since the late 90s. Personally, as I mentioned, we have invested since the late 90s ourselves. If you add Keith and Rick to that mix, they've been managing real estate since the early 80s. I founded the company in 2000. We now own close to 1,000 units. And we have, together, including myself, have a substantial equity stake in all these ventures. And therefore, we have a complete win-win alignment with investors. So the money goes first back to you. So if we are unable to return money to you, then we make no money on the equity side. We take some small fees, but they're very small. So we have a strong interest to make these assets grow because we're going to take a share of the profits down the road. On the right-hand side, you see all the various LPs we have had open, and prior to LP1, we had a number of corporations. Most of them are now sold off with large profits. There is a document on our website you can download, which shows in great detail on 4 pages various buildings we've bought and sold and still own over the last decade or so. In LP1, for example, despite 1 of 5 buildings losing money, actually, in Paul River, BC, we were able to return about a 50% return to our investors. LP2 is also closed. We had about 120 to 130% return for the investors. The other 4 LPs are currently still running. That means they are still active. They still own assets. They haven't been closed. LP3 and LP4 has been returning money as we sold buildings off or from cash flow. But both of these LPs will run for some time. LP3 probably another year or two, LP4 probably another 4 years before we close them. Prism A is our biggest fund. We raised about 15 million, and we've continually sending out cash flow to investors as we speak. King's Castle is our current fund, where we raised about $7.5 million, although another $500,000 is coming in the next few weeks from closings Denise and Scotty did over the last few weeks. So we are about 60% sold out, and that puts the total raise to about $43 million on an asset base of about $100 million. So this is how we have grown over the last few years. We had the good fortune perhaps to sell off some buildings in Edmonton in the year 2007 and haven't grown as fast since. In fact, started selling off some more assets and have also moved some money into land, which we will not talk about tonight. However, might do in the near future, probably early next year, once we get our land offering all lined up. We own some land in Cold Lake, which is the orange bar up there, and some small land parcels in Yorkton, Saskatchewan, which we intend to develop over the next few years. Very profitable venture, potentially far more profitable than apartment buildings, but the risk, of course, is slightly higher. So we'll keep it as a separate fund, and tonight we'll talk only about apartment buildings. We are close to 1,000 units, and we'll see where the journey will go as we move forward. So again, as I mentioned, we love apartment buildings because you get cash flow and they're very stable, and we think you should love them too. So with that chart, I want to pass it to Christine for a few slides, and I'll be back, and then she'll be back as well. So let me pass it to Christine as she'll explain to you a typical investment if you had invested in apartment buildings over the last 25 years. Christine.
Awesome. Thank you so much, Thomas. And thanks, everybody, for being online tonight. Just a quick reminder that you have the panel on the right-hand side where you're able to type in your questions. Highly encourage you, as questions come up, to type them in there so that at the end of the presentation we can answer those questions for you. So as Thomas mentioned, we're all super huge real estate. We're investors in the terms of we're very passionate about real estate, and a big theme about this presentation is how can you make money in up and down markets. And as you saw from the beginning slide, the volatility of the public markets, you can actually step out of that and allocate a portion of your portfolio to something much more stable, which you can see in this chart here. This chart that you're looking at represents the private apartment building index over 27 years. And basically you can see quite clearly that regardless if there's been some kind of financial crises over time, private apartment buildings have grown in value and have remained relatively stable. So investing in this asset class is a great way to continue to grow your wealth without being subject to the volatility of the public markets. And a lot of you are probably wondering, well, where can you put your money these days? And you're looking at GICs and the returns are so poor, it's basically a negative return. And then you go and see what happens in the public markets. Just like Thomas was saying today, sometimes you win, Twitter goes through the roof, but oftentimes most people aren't great at timing markets and they end up losing. So this chart is just a great example to show you how investing in private apartment buildings is a great way to continue to grow your wealth regardless if the public markets are going up or down. And you can see the example here shows if you had invested $10,000 in 1984, what it would be worth today. One of the other reasons that we love apartment buildings is value amplification. And this also comes back to the public markets. I've spent 7 years in that space, and I've watched publicly traded companies communicate their goals to their investors. They're going to execute their business plan, and whether they did or they didn't, regardless of what had happened, somebody says something out in the marketplace, there's trouble in Europe, there's all kinds of things going on, a company can invest into its projects, and regardless, they don't get that appreciation in the market. And that is not the same case with apartment buildings, which is absolutely fantastic, and specifically private apartment buildings. So this slide here helps people understand how we create value through improving apartment building operations. So on your left here, when we find those ugly buildings, let's say in this hypothetical model, the building is producing $100,000 a year in net operating income. When you value that $100,000 a year income stream at a 5 cap, which is just technically 5%, so you take $100,000 divided by 5%, you arrive at a value of $2 million. The awesome thing about multifamily real estate and what Prestigious is able to do and has been doing for the last 14 years is we have the ability to increase those net operating income streams by being efficient property owners and managers. So what we do in this hypothetical situation is we would come in, we'd buy this building that's producing $100,000 a year of income, and we're going to move it up to $120,000 a year. And we do that through renovations and increasing rents, to decreasing our expenses, like decreasing our utility costs, etc. And when you take $120,000 and divide it by the same 5 cap, you arrive at a value of $2.4 million. So whether the stock market is going up or down, we as operators on your behalf come in there, take this asset, increase its income stream, and we take that, we go back, take the financial statements of that property back to the bank, and they say, okay, yeah, you're now worth this much more. And in this particular case, it's $400,000 more. So from an appreciation standpoint, we have the ability to add, say, 20% appreciation from $2 million to $2.4. But where it gets really good is when you start factoring leverage, because when we go buy buildings, excuse me, sorry, I have a little cold. When we go buy buildings, we don't go buy them with all cash for $2 million. We use, let's say in this example, a 75% loan-to-value mortgage, which means we come up with 25% of the value of the property. So if this property was worth $2 million, then we had to invest $500,000. And when you step back and you look at the ability to move the property value from $2 million before we improved it to $2.4 million after we improved it, that's a net increase of $400,000. Well, a $400,000 gain on a $500,000 investment is, excuse me, almost an 80% cash-on-cash return. And those are the kinds of returns that we're aiming for. Now, bear in mind, this hypothetical model does not show the expenses that we incurred in order to increase that value, but it gives you an idea of why we target apartment buildings, undervalued ones, and how we can increase their value and increase your wealth rapidly by being efficient operators. And we do that on your behalf, so that you don't need to learn how to do that. It takes 14 years to learn how to be an excellent operator. We do that for you. So in this situation, we ask you to consider investing in a private apartment limited partnership, which is what Prestigious offers. Our annual target return on investment for investors is 10%. And it's an income and growth-focused investment. You have the opportunity to invest in these apartment buildings, but you don't have to go out there and build the team and the know-how and have the 14 years of experience and know how to do this and take the time to do it. but you get to invest with us in a limited partnership that's backed by income-producing apartment buildings. And we will get into more details, but as Thomas had mentioned, you can earn a 6% DRIP, which is a reinvestment plan to grow your wealth even faster. Or for those of you that require some cash, but are really looking forward to the equity growth that we have been able to provide our investors over the years, you can also take a cash distribution. So the advantages to you as an investor, you might even be a real estate investor yourself. You might own single-family homes. You might have a portfolio such, but you get to take advantage of us, and you can diversify your portfolio by investing in apartment buildings. And in our particular limited partnership, we focus on apartments because they are the safest, or one of the safest real estate sectors of all the different asset classes. You know, you have the option to invest in commercial, industrial, and those other types of investment classes. However, apartments are the safest because not every business always needs a place to operate, but people always need a place to live. And because our limited partnership is private, it lacks that volatility that you experience in the marketplace. And because we are a limited partnership and not a REIT, we can actually grow your investment more significantly than, say, a REIT. Because a REIT has to pay out, REITs are essentially an income-based investment opportunity, whereas in our partnership, we reinvest the capital into growing the value of the apartment. Excuse me. Sorry about that, folks. This cold is taking its toll on me. We reinvest that money into the apartment buildings and grow them much faster. And the limited partnership is professionally managed. So again, you don't have to manage the manager, you don't have to do anything, and you get to benefit from our expertise. So you're probably asking yourself, how do we do what we do? And the first part of our business model comes from identifying cities with high growth potential. And as you can see in this chart here, it all starts with GDP growth. I don't know if you've been paying attention to what's happening in Canada, but definitely the West is winning. So we look for places like Alberta and Saskatchewan where there is significant GDP growth. Because what happens when there's GDP growth, there's job growth. And Canadians are very, they migrate to where the jobs are. And you hear it all the time, guys flying around to Fort McMurray and all these different places, 3 weeks in, 1 week out, because there's jobs and they pay well. So what's happening is we look for places where there's this job growth because people come and the population grows. And when people come, they don't necessarily buy right away. They look for rental apartments. And when a lot of people come looking for rental accommodation, suddenly there's a ton of demand and there's not as much available. So the vacancies go down, and basic supply and demand laws, prices go up. So that's step number one. We focus on where the jobs are at. And Alberta is a winner in this case on the world stage. For those of you that are unaware, Alberta has the third largest reserves of oil in the world. And even more significant, we have the largest reserves of unconventional oil in the world, and we're probably one of the only geopolitically stable countries with those kind of resources. So when we're on the world stage, if you're at one country thinking about who you're going to do business with, if you're the U.S., are you going to do business with Venezuela, or are you going to do business with Canada? And we are going through a big boom right now, whether you're aware of it or not. It's in the newspapers. It just depends maybe what province you're located in, whether you hear about it. But I'm sure most of you are pretty aware of the fact that there's a lot going on in Alberta, And Calgary and Edmonton have been deemed to be Canada's economic leaders of the future, which is huge. It comes right back to where we want to invest. We want to position ourselves where the jobs are going to be at and people are going to be coming so that you as a landlord can provide them with a home. And the prediction here is that these centers are going to grow approximately 3% for the next few years, which is fantastic, which means the time is now to get ahead of all of that, get into these properties so that as the herds come in, unaware our government is actually changing our immigration policies because Alberta is going through a labor shortage crisis. So there are so many jobs that are being created that they're actually having to ship people in from other parts of the world. And this map here, sorry, this chart here shows you the capital expenditures in the province, almost $100 billion in some cases, which is absolutely astronomical. These are huge amounts of money. And this is looking at the past. And so just to give you an example of what's happened, the repercussions of this capital investment into the province, you can see right here on this chart the average price per door of multifamily in Edmonton. It's absolutely incredible. It's quite the increase over time. So moving forward, you as an investor want to be positioned for the future, and you can see Alberta's where it's at. If you take a look at Canada, Alberta is outperforming Canada, or projected to outperform the national average. And from the construction forecast, I mean, if you take a look at this chart here, you know, you can imagine, if those of you that remember what was happening in 2007, 2008 in the Alberta economy, it was absolutely insane during the boom. People at McDonald's were getting paid $25 just because McDonald's couldn't find people to come and work for them because everyone was working in the oil sands. And if we look at where we are today, we're almost the same stage, but what's even more impressive is where we need to be in 5 years. And it's the same thing. Here we are today, and this is the entire oil sands industry over the next 25 years, the amount of jobs that are going to be required, and I think this says it all. We're at 300,000 jobs, and we're going to require almost 600,000 jobs over the next 8 years. It's absolutely astronomical, and you folks are in a fantastic position to get involved and ride the economic wave that's coming and is currently, it's undergoing right now and is going to be coming for a long time, a nice sustainable boom. So with that, I'm going to pass it back to Thomas. He's going to talk to you a little bit more about our business model and walk you through how we've created wealth for our investors in the past. So Thomas, if I've got you on the line, it would be awesome to have you.
So you can rest your voice a bit.
Thank you.
So as we mentioned earlier, we buy what are typically called non-prestigious properties or ugly properties, but you often make the most money in the ugliest buildings. Coming back to Twitter, which, as I mentioned, IPO today, November 7th, it was certainly a good investment for the investment bankers who made hundreds of millions of dollars today by cashing in their options and selling all the stock they would acquire at the $26 share price and probably unloading it at 40 odd and change. Question is it still a good investment for you buying Twitter tomorrow at, you know, $46 a share? So extremely speculative. So what we do is a fairly boring, predictable business model, but we cannot deliver a 70% return in a year. It's just not possible in the business model. We can certainly do a 70% return in 5 or 7 or 8 or 10 years. Very doable, and we've been doing this consistently over the years. And how we do that is we buy these older buildings, uglier buildings with deficiencies or often just neglected management, and we upgrade them. We can influence expenses to a degree by putting in more efficient boilers, perhaps. and more efficient lighting like LED lightings, but that goes only so far. The biggest value add model really happens by improving the asset and getting the rents up, because by and large rent growth drives value growth. So if rents go up 20, 30, 40%, values usually go up similar 20, 30, 40%. And then the property appreciates. We then occasionally sell it, or we refinance it and then redeploy that capital, as you see on the left-hand side, and commingle with your own money in the same LP and buy more buildings. And specifically, I'll talk about the building in Red Deer. We are doing just that in Kings Castle. So I just want to show you some pictures here quickly over the next few slides of what we typically buy. This is a building in Dallas. You see there's some rot in the balconies, there's ugly sheds, see that on the bottom left, you see that tree hanging on the roofs, you know, clogging up the eaves, but also damaging the roof. So we, you know, cut back the trees, we paint the building, and this is how the property looks today. We painted it all, fixed all the issues, we cut back the shrubs and cut the grass and, you know, added new flowers, and it looks like a beautiful property. This is one of our largest properties, not our most valuable one actually. This is the one in Calgary. This is our biggest asset we own. It's 300 units. It's about half an hour north of Dallas in a city called Denton. It's just a joy to own. The cash flow now is easily $100,000 a month, a year, after all expenses, after mortgage payment, after everything, with the rent roll approaching $200,000 a month after we took it over with a rent roll of, you know, $120,000 a month or so. This is a building in Red Deer. For example, we bought that, you know, old stucco building. It was a 20-suiter, I think. And this is how it looks today. You know, after 2 years of fixing it up, and painted the balconies, changed the railings, put new siding on, and put some railings, and painted the parking lot. The trick is always to not over upgrade. So here's an older, uglier kitchen. Actually, it doesn't look so bad, actually. But you see in the front, for example, there's something missing here. And this is how it looks today, right? Again, it doesn't have a granite counter, but it looks like a granite counter. It's actually a fake granite counter, and as you see, it's the same cupboard. We just painted it, right? And yeah, we could rip it all out and put a brand new kitchen in, but that's probably $3,000 to $5,000. It's often not worth it. But you paint it, you may put new handles on, maybe change the sink depending on the quality. It looks just a lot nicer. Similar here, that's the same building in Red Deer. You see the kitchen on the left and the kitchen on the right. It's the same kitchen, same cupboards actually. We just put some tiles on top of the counter and the rim on it, and then put new pewter knobs on it for $3 a pop, and painted it. So it looks very, you know, much better, and it costs maybe a few $100s to do that, as opposed to a brand new kitchen for, you know, $8,000 to $10,000 perhaps. Similar in bathrooms, you know, you can see here new vanities. You can buy those at Rona or Home Depot for very, very inexpensive money. New flooring. Similar here, put the little backsplashes, you know, buy a brand new vanity for like $120. All not that expensive actually, but makes a big difference in the curb appeal and the appeal to tenants, and you can just then charge more rents. So this is how it looks like if you do it for a number of years. I don't want to go through all the numbers to bore you really, but this is a complete list of all the buildings we bought in the various prestigious properties companies over the years, and it shows the purchase price and the selling price. And out of 36 transactions thus far, there was 2 mishaps, one in Detroit, Michigan, where we should never have gone, and my partner, who steered me there many moons ago, just not with the company anymore, and also a building in Powell River, where we had bought it in 06 and had envisioned to sell it into the Olympic boom in Vancouver, which unfortunately coincided with the financial crisis, so we decided to unload these assets, and one of them also, 3 buildings, lost some money. Nevertheless, that building was an LP1. We still, as I mentioned earlier, returned a 50% return to LP1 investors. So by and large, we have done extremely well, and every so often you have a home run, like the building number 9, for example, here, Windsor Estates, which is owned by myself and about 10 investors, which went from a value of about 5 million to approximately 13, 14 million today. That's a long-term hold. We still own it, and at the moment there's no plan of selling it. Some buildings are just so good, like building 36 we just acquired, or building 30 in Calgary, or 28 in Stony Plain, are just great assets. You might want to sit on them forever. A bit like Warren Buffett, my favorite holding period is forever. Well, let's talk specifically about 2 case studies. And as I mentioned earlier, there's more on our website called Track Record. This is a building portfolio we acquired over about 2 years from 07 to 09, sort of around financial crisis time in Yorkton, Saskatchewan. It's about an hour and a half south east of Regina, towards the Manitoba border. We acquired these assets for about $4.5 million altogether, and sold them in about 2 years ago for $7.7 million, with a very large gain. And of course, if you look at the cash-on-cash gain along the lines of what Christine explained to you, the cash-on-cash return was substantial. Some of these LPs are still waiting for the last building to sell, so it's tough to give a precise investor ROI, because the money obviously is commingled with 3, 4 other buildings in the same LP. So each LP you might want to invest in this case Kings Castle, usually has a number of buildings, not just one. It usually has 3 or 4 or 5 buildings in it to get some diversification. This happened to be in 2 LPs actually, Kings in Prism A and LP3. Another building we sold last year in Prism A was a building in Campbell River. Again, not the sexiest and hottest market, but Campbell River, certainly we could acquire this asset very, very inexpensively. We purchased the building for $4.4 million in September of 08 for about $1 million cash. We invested all the cash flow in the bit on top and sold it to a REIT about a year ago now, November 2012, and had a nice $800,000 gain on the $1 million cash invested. Let's add some cost perhaps of $200,000 to that. Some LP overhead of perhaps another 100 or 200. Still a very good gain in a market we really in the end didn't want to accumulate more and wanted to get out of. Because Vancouver Island is a terrible economic picture. If you look at Victoria today, it's not a great market to invest in. It's not where the job growth is, so we decided to exit Vancouver Island in the Sunshine Coast, and we had a nice gain here. And again, as I mentioned, substantial cash-on-cash and investor ROIs. So specifically in Kings Castle, which is the current LP open, it really works as follows. So there is currently about 130 odd investors already in Kings Castle. Half is cash and roughly half is RSP. And in addition, we bring to the table our time and expertise and personal guarantees on mortgages and also our own cash. And then we acquire assets. We own the bottom 3 assets already, and I'll talk about those in a minute here. And we are about to acquire, or will most likely acquire, this building on the left, which is another building in Red Deer. It's not purchased yet. We have not waived conditions, but we anticipate that we're going to waive conditions in the next few weeks for an anticipated January closing. So let me talk about each of these buildings specifically, because if you decide to invest with us, you will co-own these 4 buildings, plus a share in a land parcel we also own in Cold Lake, which we can talk about as well, which is in our investment brochure. This is the first building we bought about 3 years ago. It's owned about 25% by Kings Castle. The majority of this building, 75%, is owned by the previous LP, Prism A. It's a 120-unit building in Calgary, close to the airport, in Castle Ridge, close to the LRT, which has just been extended. We acquired the asset in 2011 for $14.65 million, with an NOI, which is a net operating income, of about $900,000, which is a cap rate of about 6%, which is actually quite good for Calgary. We did invest a bit of money in the asset, but it was actually fairly well upgraded and not as ugly as we typically buy. So we changed the on-site manager, we changed the rents, we changed the management team, and we substantially increased the rent over the last 3 years to the point that, in our opinion, the property is worth about $20 million today. We received an offer about a year ago for 19.8. We thought that was too low, and again, it's one of those assets where ideally you will hold it forever. And when the mortgage comes due in about 2 years, we might just refinance it and continue holding it. It's just such a great location. When we bought the asset, as an example, we were renting 2 bedrooms, or the previous owner was renting 2 bedrooms for about $1,000 to $1,050. Today, the 2 bedrooms, the last one we just rented was $1,400. So it's up almost 30% in rent in about 3 years. So it's a 10% year-over-year rent growth, which is on the very high side of rental upside. But it's a testament to maybe of our abilities, but certainly also to the strength of the Calgary market, because vacancies are very, very tight right now in Calgary. The second building we acquired about a year ago is in Red Deer, halfway between Edmonton and Calgary. Historically, it's close to a building I used to own. Actually, it's across the street. Historically, Red Deer prices were higher than Edmonton, and rents were higher too. For some reason, in the last few years, rents are actually lower than Edmonton, and the prices are lower too. But we might get back to a situation in 2 or 3 years where, again, Red Deer is halfway between Edmonton and Calgary price-wise and rent-wise. We acquired the asset for $1.75 million about a year ago at a 5.4 cap, and today the NOI is about $125,000 and expected to grow another 10% or so over next year. We estimate the value to be about $2.2 million. It's listed for sale right now for $2.3, but we just actually decided to cancel the listing and just refinance it, keep it. So we are putting on a higher mortgage, pulling about $400,000 cash out. And with this cash and the cash we have at hand, we're going to buy another building in Red Deer about a block away. So this building, as I said, went from a value of $1.75 million to $2.1 million in about, let's call it a year, although we got the appraisal only 4 or 5 months later. So that's a substantial cash-on-cash return, because we really all invested only about $500,000 into this asset, and it went up about $400,000 on $500. So the figures Christine showed you earlier are not just theoretical numbers. So this is all doable in the real world if you know what you're doing and if you buy the right markets with the right team and the right leverage and the right syndication structure. The third building we just acquired a few weeks ago in early October it's called Castle Harbor. It's in Edmonton, in Castle Downs, which is north Edmonton. Nice middle-class neighborhood. Very large 2 bedrooms. Also, the Red Deer building, I forgot to mention, also has all 2 bedrooms. We just acquired the asset. We are actually just collecting rent for the first time just the last few days, because now it's early November. So Keith and his team is just collecting rent just the last week. And we anticipate fairly large rent increases for the first quarter of next year, from about $950 on average to about $1,150, maybe $1,200. So about $200 rent increase, which is over 20%. And then after that, I think we're going to get probably a 3, 4, 8% a year rent increase for the next few years, given the size of the units and the location. So we can move it fairly quickly from a sub-5 cap to a 6 cap with an improved NOI in about a year. And we also expect the value to increase. We have a 1-year mortgage on this building because we expect the value to go up in a year. We will most likely refinance the building in a year and pull some equity out and just lock in a low interest rate short-term, long-term mortgage. So often we buy these buildings with a short-term mortgage because the biggest bump comes in year 1, and then we lock in a long-term mortgage for often 5 years. And that's why we ask you to stay with us for 5 to 7 years. We're not a short-term speculative, 1 or 2 year fund like perhaps some construction projects. We want to invest over 5 to 7 years. So therefore, if you cannot wait 5 years, then you should not invest with us. It's really designed as a patient capital appreciation strategy with some cash flow options for those who want it. It's not designed like a Twitter of the real estate space. And the last building, which we will most likely, as I mentioned, acquire in January, because we have not raised condition, but we anticipate a January 2014 closing. Again, it's 18 units. It's about a block away from the existing Red Deer building, so there's some management efficiencies. 17 of the 18 units, again, are 2 bedrooms. We bought or have the building under contract for $1.89 million. We envision it to be worth over $2 million because it's already appraised for $2 million. We just got the appraisal, in fact, today. We can actually send that to you if you want to invest with us to verify those figures. And we envision that that building will be worth probably about $2.2 million or so in a year after acquisition, so early 2015. Again, some great upside, and all we need to buy this asset is about $400,000, which we will get from the refi, and we have some cash at hand, and some of the money which is coming in, and hopefully some of the people on the line here will decide to invest with us as well. So you will co-own these 4 assets if you decide to invest in King's Castle. Christine, do you want to take it from here, or how's your voice?
Sure, I'll take it a little bit longer, and then I might pass it back to you for the Q&A, just because I don't want to be coughing throughout the whole presentation. So, Thomas, that was fantastic. For those of you that are on the line, those are the buildings you would co-own. These buildings when you decide to invest in King's Castle. You get to participate and co-own these excellent assets that are located in Alberta. Right now it's 100% focused on Alberta. For those of you that are RAIN members, you probably just saw that Edmonton just became the top investment city, and Calgary is number 2, and Red Deer is number 6. So, adding Castle Harbor, 71 units of the 118 units that are already in this fund in Edmonton is, you're well positioned to ride the wave that's coming. As you know, generally, Edmonton and Calgary go through these cycles, and Edmonton tends to lag Calgary by approximately 12 to 18 months because, Calgary is the headquarters where business decisions are made, but then they're actually employed in Edmonton and up by Upgrader Alley, and then it's the closest stop to the oil sands, which is a huge driver. So as an investor, you get to invest in this fund. This fund then goes and buys these apartment buildings. It's an excellent way to invest in apartment buildings for growth. For those of you that need a little bit of cash in hand, you can take the 5% distribution. The sooner you invest into King's Castle, the better, actually, because every quarter you start getting paid. So whether you opt for the 5% cash distribution or the 6% drip, you get those. You get paid every quarter on that. So it's definitely a great incentive to get in there, and King's Castle is actually already 60% sold, and we've been doing a lot of marketing lately. There's a lot of interest, and I can see this thing selling out pretty early next year, and it's one of the best LPs I've seen for a while, just with the assets that are in it, the upside that they have, and it's a great time to get positioned in Alberta. So whether you're single-family investor or just somebody who would like to invest in real estate, don't know how, don't have the time, this is a route you can take. So what you need is a minimum of a $20,000 investment, and you can invest either outside your registered plans or inside your registered plans. So if you wanted to invest within your RRSP or TFSA, etc., that's all doable. Inside the registered plans, of course, There is no cash distribution. It doesn't make sense to do that, so it's just an accumulation. What you do is accumulate more units on an annual basis, of course, and then participate in the growth of the buildings over time. We're really huge on investor communication and transparency, what's going to happen. So you're going to invest and you're going to get a login here and a password, and these are some of the documents that you're going to be able to have access to at all times. So audited financial statements, you get your filings for CRA, purchase agreements, appraisals. As Thomas had already mentioned, the building that we have under contract, if you want to have a look at what the appraisal said, we're really happy to share that information with you. We know that there's a lot of choices out there, and those of you that want to invest in real estate, we think that when you're going to go and invest with someone, it all comes down to, their experience and their track record. And there are a lot of groups out there. A lot of them disappeared in 2008, and a lot of them had just got started in 2008 and 2009. And what makes Prestigious different is that we've been able to survive and thrive through up and down markets, and including the Great Recession. So if you're going to invest your money with a team, I think that speaks volumes with, having the experience of knowing how to navigate those kinds of waters. And our asset base just goes to show the trust that we have from our investors and what we've been able to accomplish, having $100 million in assets already. We are very much focused on growth cities, and we also limit your downside because we focus on primary markets, so large cities with large populations. Obviously, there's some excellent opportunities out there in secondary markets. But if any of you have ever invested in secondary markets, smaller centers that are outside of big cities, and you were an owner in 2008, I know of places just outside of Edmonton that, are based on the natural gas sector, and there was 25% vacancy, just like that. So, you never get to earn a higher rate of return without taking on more risk. So within this fund, you have the opportunity to get positioned to excellent markets that have a ton of upside potential, and you actually get to own real estate hassle-free. Because I myself am a real estate investor, but I still have to manage the manager, so it's not something that is as passive as people like to think it is. If you want to contact us, there's a green button on our website, www.pressprop.com. Highly encourage you to go there right now and log in and provide us with your contact information so we can follow up with you. But I'm going to pull up the questions here for those of you that have some questions that you are on your mind right now. Please go ahead and type them in. In the meantime, I'm just going to go through some of the questions here, so if you just give me a moment. So Thomas, we have a question from Gord E. And his question is the return, the monthly return in the form of return of capital? So I think the question here is, first of all, we pay cash distributions on a quarterly basis. But Thomas, do you want to address that question?
Typically, you expense, certain expenses get capitalized. So if you're an accounting freak, like sales commissions, there's commissions because we're selling our product through exempt market dealers for about 3 years now. They changed the rules. There's upstart costs, LP costs. So each LP is a mini IPO if you want. Those costs get amortized, capitalized, and then amortized over 5 years. There's, as I mentioned, upstart costs to the buildings, usually realtor fees, etc. So usually you are in a negative income situation for the first few years, which means that if I send you money, it cannot be income because I have no taxable income, and therefore by definition it is a return of capital. After perhaps 2 or 3 years, when the expenses are usually a lot lower and the rents are higher, we tend to depreciate the buildings. We can depreciate buildings up to 4%, and to bring the taxable income to 0 as well. And again, so even after 3 years or 4 years, you get a check. That's, again, also usually return of capital. So usually there is no taxes payable on the money we send you. Similar to a REIT, perhaps. There is usually very little CCA accumulated, and at the end, if you sell a building, it's usually a capital gain, because we hold real estate assets for income purposes, and if you sell such assets 5, 6, 8, 10 years from now, you get a capital gain allocation, and you pay a lot less tax on that. So as a comparison, one of the buildings I mentioned earlier, this building in the West End in Edmonton, for the first time in 8 years, I've actually started paying income taxes to the government, because the rent is now so high that even after depreciation and after all the mortgages and operating income, we actually have taxable income, which is not so common if you have a levered real estate investment.
Awesome. Thank you. Let's see here. I got another question from Grant. Last name initial is M. And it says, would it be possible to transfer the assets of a self-directed RSP? And I'm thinking he's invested in some ETFs into the King's Castle Limited Partnership.
Sorry.
So
yes, the answer is if you have an asset if you have an asset for sale, let's say if you own an apartment building, which we think we want to acquire, you can certainly. We've done it once actually in LP4. We acquired an asset, and instead of paying you cash, we paid you LP units. So you can do that. But I'm not sure whether that's the question. So maybe I need some clarification on the question.
I think I'm going to take a shot at it here, Thomas, if you don't mind. I think the question is if somebody's already invested into different kinds of investments within their RSPs, and I think in this particular person's situation, they own some ETFs in their self-directed RSP account, they could invest in King's Castle, but what they would have to do is sell whatever it is that they have. Like if it happens to be these ETFs and they're not happy with their performance, within the self-directed account you can sell, so you don't go through a tax situation, and then you can redirect those funds into the King's Castle Limited Partnership.
Right.
I think that might be what the question was here.
So I mean, if you go to our website, there's a whole section on which explains the whole RSP process. It's a bit more cumbersome than we all like it to be. The paperwork is just still not all that great. You have to open a self-directed RSP account, and then you have to tell the trustee, which is usually Olympia Trust, to move money to us in exchange for RSP investments. And you can certainly move over a lot of other investments like stocks or ETFs to Olympia Trust. So they're just a trustee, because any RSP has to be held by a trustee, such as Royal Bank or TD Waterhouse or Laurentian Bank or B2B Trust or Olympia Trust or Canadian Western Bank. There's probably a dozen or 20 in Canada. And then within that RSP, you decide whatever you want to put in there. You can buy stocks, you can buy bonds, you can buy mutual funds, you can buy ETFs, or you can buy private exempt securities such as ours, as in a whole plethora of investments. But I personally cannot give you advice what you should invest in. I can certainly give you my opinion. But that's why you have to work with an advisor through one of the EMDs. Scotty, who is one of the partners in Pressprop, is one of the licensed advisors, and Denise as well. And you have to fill out a form called a KYC form, a Know Your Client form. So if we see, for example, that you have only $50,000 to invest overall, we might not recommend that you put the money into PressPop, which has a minimum investment of $20,000. But you should discuss that financial situation individually with your advisor. And once we know your name and phone number, we can then point you to a person who maybe lives in the city you are.
Okay, and because we promised these folks that we keep it to an hour, I've got two very good questions here. I just was hoping that you can answer. One is from Leaf, last name starts with an A, and the question is, have you been able to achieve an ROI better than 10%, and what happens in this type of situation? So I think the question is how do you deliver a higher than 10% return?
Well, as we mentioned earlier, I mean, this is obviously a target return because I cannot guarantee anything because Alberta, you know, people might leave tomorrow and Alberta declines in value, right? That's certainly possible. So essentially, what if you invest with us, you become a co-owner of assets, and all I can guarantee you is that we work our hardest to make sure the assets perform. What I don't know is what the world will look like in 2013, 2018, or 2020, or 2016. I still think the interest rates will be fairly low. In fact, today, the European Central Bank announced to lower the prime rate to 0.25% because the growth in Europe is so sluggish. It would not surprise me if that happens in Canada too. So I think we are in for a long time in a low interest rate environment. So to me, it makes sense to buy these buildings I showed you earlier at 5, 6, 7% cap rates and borrow money at 3%, 3 to 4%. That totally makes sense to me. And in time, rents go up, and in time, values go up, and in time, mortgages get paid down. So what I do know is that if I sit on an asset for 20 years, even if I did nothing and didn't do any upgrades, such as the ones we showed you, the mortgage would have been paid down substantially. I still would make money, even in a completely flat market, if I did absolutely nothing. So the combination of improving the asset, improving the rent roll, pushing the value up, and paying the mortgages down, that combination makes a very powerful leverage factor on your cash invested. And as I said, the target is 10%. We've done frequently much, much better. But of course, the market has also been very bullish until about 2007, 2008. Certainly some of our LPs, which we held through the recession, will not do as well. As I mentioned, no one will lose money, but we will likely not do 10% because we had these 3 years of recession in between. But King's Castle essentially was opened, you know, a good 2 years ago after the recession, so I think it's very, very feasible if we get 10% or more. You have exit options. We didn't talk about that actually. You can get out at any time. There's penalties though if you exit in the first 5 years. And we set the net asset value every year, and after 5 years, you can then tell us if you want to exit or potentially partially exit. So if you invest $50,000, let's say now it's worth $70,000, maybe you want to sell 10% of it, or 20%, or 30%, and then you can gradually exit, and you can make that decision sort of on a year-by-year basis. And hopefully it's higher than 10%, but we don't know. We shall see. We try to move it as high as possible, but there's no guarantee, and no one can give you a guarantee.
Awesome. Thanks so much, Thomas. There was just, you answered actually the last question, which was what's the minimum investment time period. So when you invest in King's Castle, we look for a minimum investment or time horizon of 5 years. And as Thomas mentioned, you can exit earlier than that, but there are some penalties. And anytime after 5 years, you can redeem your units. You just let us know, and we exit you at the current net asset value of those units. But as Thomas will tell you, many of our investors just hang on for the long term because every month they know that their mortgages are getting paid down, and that means tax-free equity growth for them. And
so as an example, in Prism A, which is our biggest LP, which we opened about 5 years ago, 2008, we are just sort of approaching the 5-year mark. and I had expected about a 10% exit ratio. We have about 300 investors in that fund. I would have thought maybe about 30 people would leave. So we had a bunch of cash sitting on the balance sheet, and less than 10% are exiting right now. So we're looking to place that cash again. We might send some money out. We'll see. But we do a fairly conservative cash analysis. We need to obviously have some reserves as well, because I don't want to be an unmotivated seller. I don't want to be a motivated seller. That's when you get the best prices. So in Prism A, as an example, we'll likely sell our British Columbia asset in Abbotsford. That's the next to go, probably in the second quarter next year. And so we sort of slowly exit the LP as investors want to get out. But they tend to be fairly sticky.
Okay. Well, for those of you, because we're well over time here, if we didn't address any of your questions or some of your questions, we'll make sure to follow up with you directly. We really appreciate the time that you've taken to learn about how you can invest in booming Alberta real estate. And with that, we highly encourage you and invite you to give us a call, ask us all your questions. The number's there on the screen. We'd be more than happy to engage in a conversation with you and find out if this is a great way for you to invest in apartment buildings. Thomas, is there anything else you'd like to say before we close out?
Well, you see on the bottom of the screen that so one of our trademarks is become a landlord without the hassles. Because certainly it is a lot of work, and I know many people who own their own real estate and still decide to invest with us because then they know how much work it takes. And the other trademark which we've coined is called "Don't wait to invest in real estate. Invest in real estate and wait," because time is on your side. Because you own an asset today in any growing market, be it Arizona or Florida or London, England, or certainly Alberta, where there is economic activity and inflation, prices will go up in time, not always in a straight line, but certainly they will go up. It does help to go to some museums once in a while and look at pictures of cities, perhaps Vancouver or perhaps Calgary, or perhaps the city you live in from, let's say, 100 years ago, 1913. I bet you if you bought any house, any property in 1913 in probably any city in Canada, any lot, any hotel, any restaurant, any office tower, any single-family home, it's worth a substantial factor higher today. So you can do it almost every decade. You go back 10 years, you go back 20 years, you go back 30 years. So real estate just goes up in value because we have, a political system called a democracy, where voters expect certain delivery of services from the politicians. And on average, politicians spend more than they collect. So they create debt. Debt has to be serviced. The best way to get out of debt is to make money less valuable. So if you buy a loaf of bread today, maybe it's, I don't know, $4 at Safeway. But that same bread maybe was $2, 10 years ago. Same bread, nothing has changed. But the bread is now twice as much. So similar in real estate, you just need to sit on the asset long enough, you will make money. So that the trick is to be able to hold it long enough, and that's why you need some cash flow to do that. And you apply some magic to that, and you actually improve the bread, make it better, make it sexier, make it better. The value goes up over inflation, and you pay a mortgage down. It's not a difficult business model. So I think we got a great formula, a great team, and I want to invite you to co-invest with us. So I think it's a good investment class to be in with a portion of your money. Don't put all your money in it, because there's always risks that some politician shuts off the oil pipelines. But we heard just yesterday that Christy Clark and Alison Redford now will work together on getting the Northern Gateway pipeline done to Western Canada. We'll probably pump oil east as well to New Brunswick, and at some point maybe with a second Christie, maybe Chris Christie from the U.S., perhaps as the next U.S. president. They might even open the XL pipeline. Who knows? So I think the future is bright, and as you know from my accent, I'm not an Albertan or BC person by birth, but I think BC and Alberta together have an enormous future potential, and it's a great place to invest and live, actually, you know. So I invite you to join us. And thank you for your time tonight. Thank you.